So in the next 10 minutes or so, I want to maybe zoom out a little and share with you a few surprising observations about the state of climate tech and why we at Extantia believe now is the time to hunt for gigacorns and not unicorns. All right, let's start by maybe putting this into context real quick. What do you see? It looks like some sort of dystopian sci-fi scene taken out of Lord of the Rings, right? Except that it's not sci-fi, it's in Germany. What you see here, this yellow splurge, is acid drainage from the coal mines in East Germany where I grew up. And what happens when you mine lignite, a soft coal that's cheap, but produces 22 times more CO2 than other fossil fuels and is highly toxic. Air pollution from fossil fuels kills 8 million people every year. Now, the burning problem of our time is this: we're running out of time. If we want to scale the best solutions a lot quicker, so as Marco said, we need to find the doers, not the talkers, and we massively need to boost the supply of technology now. Now here's the dilemma we're up against. Through 2030, the vast majority of CO2 savings will come from technologies that we already have existing available today. So think of your solar or your wind. But in 2050, almost half of the necessary reductions that we need will come from tech that's still in its demonstration or prototype phase. So think of your hydrogen-based processes. We need a lot more venture investment to go into these emerging technologies to make them prime time ready, right, before it's too late. So bottom line is this: we don't have a choice between deploying existing tech or innovation. We need massive progress on both sides all at once to make the best climate technologies price competitive before it's too late. Do we have the market for that? Well, the next observation I want to share with you is about the two-pocket paradox. Now let's maybe start with the elephant in the room. Many of you might still be thinking, sustainability, just another hype. It's probably clean tech wave 1.0 all over, where investors lost more than half of the 25 billion they put into startups about a decade ago. Now that's kind of led to a two-pocket thinking, if you like. You either maximize your impact pocket or you maximize your financial returns pocket, but you can't do both. Now what's happened here is that this led to massive mispricing in climate tech investing markets. Because a bit like with the internet sector, right, during the dot-com bubble emerged a lot leaner, commercialization cycles in climate tech sped up a lot. So there's an arbitrage opportunity to invest into this megatrend. Let me share a couple of observations with you why we think that's the case. $40 trillion. That's the figure of assets under management today committed to climate or some sort of divestment from oil and gas. 20% of the largest corporates worldwide now have some sort of public net zero target they need to meet. If you look on the policy side, similar story. Carbon prices have gone up by about 500%. So from a cost of capital perspective, doing nothing about your emissions will actually be really expensive. Now, if you throw all of these things into one bucket and look at what comes out in terms of market dynamics, there's two observations I think are interesting and worth sharing with you. On the supply side of climate tech innovation, we see a new class of decarbonization innovators popping up at billion-dollar valuations. Swedish battery maker Northvolt at 12 billion, or the UK's renewable energy producer at 4.6 billion. Now, on the demand side, money's actually followed that innovation. Not just a new class of climate tech venture capital firms such as Extantia, focused on early stage investing, where we see lots of opportunity because In the later stages, valuations are already at $500 million to $1 billion. But also larger investment firms committing billions of dollars of follow-on capital that wasn't there before. This summer, in July alone, private equity firms committed $16 billion to climate tech. Now the question, of course, is, does that money actually go to where it's most needed? The third observation I want to share with you is about what I'd like to call the allocation paradox. All right, let's start with having a look across the universe of climate tech venture capital firms. Now, what you'll find is that more than 80% of them are US-based and primarily focus on digital business models. We need a more diversified focus of companies finding both the best software and hardware solutions. Now, if you drill deeper and look at how this plays out across the sector level, there's a new PwC report that will be launched next week that we've contributed to. So can't share the exact numbers with you quite yet, but here's the bottom line of the findings. About 80% of the capital goes to sectors that account for only 20% of global greenhouse gas emissions. Now, many of us will have invested into e-scooters or some sort of car sharing app, all really great investments for different reasons. But if you do the carbon math, these solutions alone won't move the needle on the KPIs of the climate crisis. So ultimately, what I want to say is, think about it. The fact that we miss diversity in how capital is allocated actually means that some really promising sectors, such as your sustainable buildings and construction, are actually starved for capital because investors struggle to get excited about hardware spaces. Now, this is why we at Extantia are tech agnostic and are hunting for what we'd like to call gigacorns. So in other words, tech innovators with the potential to one day save over 1 gigaton of CO2 emissions. That's 2% of your global emissions. And doing so with scalable business models, defensible tech, and really exceptional teams, so your unicorn element, if you like. Now that brings us to the million-dollar question of sustainability, of course, that Marco has asked all of us to reflect on for this year's NOAH. How much CO2 does your solution reduce? Now, the problem with answering that question is that ESG and impact metrics are an alphabet soup. There's no real gold standard, right? Especially not in private markets. So what's happened is that companies and investors alike have actually started competing over impact measurement frameworks. Then what should be happening is actually way more transparency on the how-to of measurement. So this is why we at Extantia decided to work with our in-house scientists from Oxford and Cambridge University and decided to open source our entire climate measurement, our reporting tools, and our best practices, and how we project the time to impact for each company, and how these projections then feed into the company valuations. Why? Yeah, because we want others to make good investment decisions and want to empower an entire ecosystem of impact innovation. My colleague Sebastian and a couple of cool gigacorn founders are up next to tell you what the next big thing might look like in the energy sector, so stay tuned and thanks a lot.